Have you ever wondered why the United States, the world's #1 superpower, continues to buy more than it sells? For nearly half a century, America has carried one of the largest trade deficits in human history, consistently topping global rankings for import surpluses. It's an economic paradox. The wealthiest nation on Earth is also the world's biggest debtor. What's really behind this seemingly irreversible economic pattern? Is it reckless spending, declining manufacturing? Or could an invisible force be manipulating the balance of global trade behind the scenes? In today's episode, WorldView Today unpacks the complex layers of the U.S. trade deficit, an issue rooted in economics but shaped by high-stakes global politics. This is more than just a spreadsheet problem. It's a strategic chess game between the world's most powerful nations. Welcome to WorldView Today, where the truth doesn't always align with popular opinion. Today, we begin with a simple yet surprisingly thorny question. Why does the United States, the world's leading superpower, keep buying more than it sells? It sounds counterintuitive. Most people assume that powerful nations export more, earning money from every corner of the globe. But if you look at the data over the past 50 years, a bizarre reality emerges. The U.S. holds the largest trade deficit on the planet, and it's doing just fine. In fact, America doesn't just run a trade deficit, it's essentially shouldering the world's net imports. You heard that right. When we look at global current account balances, the U.S. sits firmly at the bottom, deep in the red. Meanwhile, countries like China, Japan, Germany, and major oil exporters show consistent surpluses. In other words, the world produces. America consumes. The entire planet manufactures to meet American demand. Some economists have labeled this the power of American consumption. Sounds glamorous. But former President Donald Trump didn't see it that way. To him, it was an insult. The moment he took office, he made it crystal clear. We will no longer let China, Mexico, or anyone else drain the lifeblood of our economy. What followed was a full-blown trade war. Tariffs, tightened controls, threats to pull out of international agreements. The official reasons? Borders, drugs, national security, immigration. The real reason? Trade deficit. Many dismissed Trump's approach as impulsive or emotional. But beneath the drama lies a much bigger question. Is the trade deficit actually a problem, or simply the byproduct of how the U.S. runs the global economy? This one small question opens the door to a cascade of issues, ranging from American consumer habits, monetary policy, and exchange rates to global capital flows, and whether Americans are, in fact, living too comfortably. And behind every "made in China" or "assembled in Mexico" label lies a deeper negotiation, one of politics, economics, and power among nations. What exactly is a trade deficit? Sounds like an intimidating term from a macroeconomics textbook, but it's actually pretty simple. To put it plainly, a trade deficit happens when a country buys more than it sells. Imports come flooding in, but exports, not so much. It's like making $10,000 a month, but spending $15,000, covering the gap with credit cards or loans. That's essentially what the U.S. is doing, on a national scale. So how did we get here? There are two common explanations. 1. The U.S. imports too much. Some say it's because goods from countries like China, Vietnam, and Indonesia are dirt cheap. Cheap labor, government subsidies, even accusations of dumping, selling below cost to take over market share. American consumers see a low price and decent quality, and they spend. 2. The U.S. exports too little. Others argue that American products simply can't compete. Labor is expensive, taxes are high, regulations are tight. The result? U.S.-made goods don't sell like iPhones assembled in China or TVs made in Korea. Sounds reasonable, but the real story runs much deeper. Ask an economics student or a gray-haired professor at Harvard, and they won't talk about factories or shipping containers. They'll talk about savings. That's right, savings. Confused? You're not alone. Because according to many economists, The root cause of America's trade deficit isn't cheap Chinese goods. It's that the U.S. saves too little while spending and investing too much. Think of it like this. You've got no money left over at the end of the month, but you're still borrowing to open a new shop, lease a bigger space, launch ads. What happens? Money flows out. And for the U.S., that money flows beyond its borders. The problem isn't that China is too cheap. The problem is that America is too eager to consume. Here's the twist. The world keeps producing, and America keeps buying. Some call the U.S. a debtor nation. Others say it's funding the entire global supply chain. Sounds paradoxical? It is. And that's just the tip of the iceberg. The hidden part, far more dangerous and surprising, will be uncovered in our next segment. Let's put the confusing charts aside for a moment. To truly understand why the United States can't seem to escape the cycle of buying more than it sells, we need to revisit one surprisingly simple, yet often overlooked, equation. Trade balance, savings. Investment, dry economics? Maybe, but let's peel back the layers like an onion. And yes, each one might make your eyes sting. First off, savings in economics isn't just money stuffed in a piggy bank. It's any part of your income that you don't spend. If you make $100,000 a year and spend $60,000, the remaining $40,000, whether you stash it in a bank or invest in stocks, counts as savings. And investment isn't about flipping real estate. It means spending to build something new. A factory, a company, a road, anything that increases future production capacity. Now picture this. You own a clothing store. You import cheap, stylish goods from China. They sell well and yield high profit margins. But over time, you realize sales aren't keeping up with expenses. Inventory is piling up. Debt is rising. Instead of cutting back, you borrow more to import even more products. Sound familiar? That's the United States in a nutshell. America spends aggressively, both its people and its government. It consumes more than it produces. And to cover the gap, it borrows from abroad. In essence, the U.S. imports goods and exports debt. That's the core of America's trade deficit. It's not because American products aren't competitive. It's because the country lives large, without saving enough to pay for it. This isn't something that was forced on the U.S. It's a deliberate choice, a system built by design. And yes, there's a price. Even the U.S. government isn't shy about big spending. Massive investments in defense, infrastructure, and social programs. But tax revenues often fall short, so what happens? More debt. Spend now, figure it out later. Borrow to live today, deal with tomorrow after the next election. The result? America's trade balance tilts like a ship in a storm. But don't forget, the U.S. can print dollars. Unlike other countries, it doesn't need to scramble for foreign currency to pay its debts. It can just inject more money into the system. And that leads to a tough question. Wait, why not just print money forever? The answer lies in what we'll uncover next, when we explore the darker role the U.S. dollar plays in the global power game. Why does the U.S. buy more than it sells? Most people give a simple answer. Because Americans love to shop. And it's not wrong. From cars and smartphones to house slippers, what doesn't the U.S. import? Americans don't just consume. They consume hard. But blaming it all on shoppers isn't quite fair. Because the real culprit is much bigger. The U.S. government. Washington spends like money doesn't matter. Trillion-dollar projects, the world's largest defense budget, stimulus packages handed out like candy. But when asked, where does the money come from? The answer is almost always, borrow it. And to fund that insatiable appetite, the U.S. has to import cheap goods from abroad, while printing bonds to sell to the very countries that just sold them those goods. It's a circular system, twisted but oddly logical. Some say, well, if the U.S. just saved more, the trade deficit would shrink. Sounds good, but it's dead wrong. That's like being knee-deep in credit card debt from reckless spending and saying, starting tomorrow, I'll save more. But you don't cut expenses. You don't change your lifestyle. You keep the store open, keep running ads like crazy. How are you going to get out of debt? Saving alone isn't enough. The entire system needs to change. Nobel Prize-winning economist Joseph Stiglitz once said, "To reduce the deficit, America must save more and consume less." It's correct, in theory. But here's the real question. Does the U.S., as the world's top consumer, actually want that? Or is it using its monetary power to hold on to a privileged position? Spend first, pay later, stay number one. And now we begin to uncover the secret weapon that has allowed America to play this game for decades, without crashing. It's not military might. It's not trade deals. It's the U.S. dollar. You think the dollar is just a currency? Wrong. It's a geopolitical weapon, the steering wheel of the global economy, the tool that allows America to buy the world without paying up front. So how does this mechanism work? Who's benefiting from it? And who's being quietly manipulated behind the scenes? We'll unpack all of that. Next, the role of the U.S. dollar. All of the theories we've discussed so far leave out one critical factor: the U.S. dollar, the world's reserve currency. The dollar acts like an invisible hand, theoretically adjusting itself to balance global trade. In principle, if the U.S. runs a trade deficit, the dollar should weaken. A cheaper dollar makes American goods more affordable abroad, boosting exports while curbing imports. But here's the problem. The U.S. has been running trade deficits for nearly half a century. So, why hasn't the system corrected itself? A compelling theory: external interference. Many developed nations peg their currencies to the dollar to maintain economic stability. Others use their central banks to actively intervene in exchange rates, often keeping their currencies artificially undervalued. This manipulation makes their exports cheaper and contributes to persistent U.S. trade deficits. In fact, the International Monetary Fund, IMF, reported that in the early 2000s, about 1/4 of global currencies were overvalued, in some cases by more than 10% compared to unofficial market rates. Translation: currency manipulation is real and widespread. To be fair, the U.S. has also intervened in currency markets, but in a very different way. Take the Plaza Accord of 1985, for example. At the time, the dollar was too strong, making American goods prohibitively expensive and deepening the trade deficit. President Reagan's administration struck a deal with Japan, France, West Germany, and the UK. They agreed to strengthen their own currencies to help bring down the dollar's value. And it worked, at least temporarily. A weaker dollar helped narrow the trade deficit. But something changed. Since 1995, U.S. trade deficits have surged again, without any deliberate effort by the U.S. to push the dollar higher. So, if currency manipulation isn't the main driver anymore, what is? That question leads us deeper into the architecture of the global economy, where the dollar is no longer just a currency, but a strategic weapon. And what's keeping this system alive, even as the deficits grow? That's where we go next. Global capital flows and the trade deficit. When people talk about trade deficits, they usually focus on goods, the most visible layer of a much deeper economic undercurrent. But in reality, money doesn't just flow through shipping containers. It flows through bonds, stocks, and cross-border investments. Yes, America imports goods, but it exports financial assets. And surprisingly, the world can't get enough of them. From U.S. Treasury bonds to Wall Street equities, global investors are lining up to buy into the American financial system. When you factor in these capital flows, the trade picture suddenly looks more balanced than most people think. So here's the question. What if the trade deficit isn't a problem at all, but a deliberate strategy? What if the U.S. is playing the role of the world's great buyer to cement its place at the heart of the global financial order? And if that's true, who's really losing? That's not an easy question, and it's where many long-held assumptions about economics begin to crumble. So what do you think? Is America's trade deficit a sign of weakness or a tool of power? Share your thoughts in the comments below. We want to hear your take. Don't forget to like, subscribe, and share WorldView Today for more bold, in-depth analysis you won't find anywhere else. We'll see you in the next video, where we continue to unravel the currency game and the hidden power of the US dollar.